Hello and welcome to the Solve to Evolve podcast. And the purpose of this podcast is to share our knowledge and insight to help individuals and business owners learn and grow. Hello and welcome to another episode of Solve to Evolve. This is episode 4. My name is Phil. We've got a fellow solver over here, Chris, and another fellow solver over here, Jono. And so today we're going to really dive into, I guess a lot of clients like to invest. You have a lot of money or a cash flow surplus and they think, what do I do with it? So there's a lot of them will dive into property, but Chris, you have a specific tax strategy that's quite efficient. Can you dive more into that?
Sure. So there's a number of ways that you can invest tax efficiently. One way that might be smart for some people is to enter into a form of hedge where you stand on both sides of a transaction. So for example, a natural hedge is where you create the demand for what you supply. The easiest way to illustrate the concept is with a farmer who grows oranges. If that farmer sells his orange crop to juice company X, and if that farmer for some reason didn't want to make or squeeze his or her own orange juice, when they go to the supermarket to buy orange juice, they should buy the orange juice from orange juice company X because they are creating the demand for what they are supplying to the market. That's an example of a hedge. In Australia, for Australian tax resident investors, our whole country is a bank and a mine and a phone company and medical company, a couple of other things, but a big chunk of our country is financial services. So if that taxpayer has a mortgage with the Commonwealth Bank, they're paying interest on a debt interest that they have issued to the bank, a mortgage. Mm-hmm. It also makes sense for that shareholder then to hold shares in the bank that it has a mortgage with. Because the more interest it pays to the bank, for example, as interest rates float up, the more profitable the bank will become and the more dividends it will pay out on the other side of the mortgage. So this is what's called a very indirect, but a banking hedge, where you are creating the demand for what you supply. A way to make that hedge much more tax efficient is to have your controlled entity, for example, a self-managed super fund, buy the shares in that bank. Because when the dividends are paid out of the bank to your super fund instead of to you personally, A, they only get taxed at 15% when you're in accumulation phase. B, they get taxed at 0%, so you get a full cash refund of the imputation credit if you're in retirement phase. But C, and the biggest benefit is that those franking credits are imputed at 30%, whereas the maximum tax rate inside the super fund is 15%. So it creates what's called a tax arbitrage or a risk-free profit from a tax rate differential. So even though you could buy those shares personally and that would still be a banking hedge, a better way to do it is to do it through a super fund that you, family, controls.
Yeah, that's right. I think you touched on a really good point. You can invest your self-managed super fund into land as well as shares, but the ultimate benefit you're saying there is taking advantage of the tax rules, and that is you can hit or achieve tax arbitrage by investing in those shares.
That's right. And I would also say that investing in land through a super fund with debt is something that needs to be considered carefully and on a case-by-case basis. Because gearing inside a low tax entity in a family group, when you may have a member of the family group that is getting taxed at 47% outside of super, makes less sense because the tax loss will be trapped inside the low tax entity while the member outside of the super fund is paying higher and higher marginal tax rate on their other sources of income.
Yeah, you made a point about gearing. So, obviously over time, that property itself would be positively geared rather than negatively geared.
Well, that's the aim.
Yep.
I mean, if you can buy positively geared property up front, sure.
Yep. Okay.
But most properties are debt funded, and if you debt fund a property, particularly in New South Wales and around Sydney, or even in the regions now, it's very hard to buy a property that is immediately positive. If you can do it, good on you. Congratulations. But in most scenarios, for the first decade or more of a property's ownership period, it is typically negatively geared if it's mortgaged.
Yep.
So you have to think about the key question, which is holding structure. What entity in your family group is the most appropriate owner of a negatively geared asset?
Yeah. Okay. So I guess what I get
Biggest
from
winner
you,
is a taxman.
yeah, that's right. So I mean, what I get from your point is people are looking at self-managed super fund investments. The most tax efficient ways to, or if they already have a property with a bank, they have a mortgage, there should be, but it'd be tax efficient to have an investment or their self-managed super fund invested in those banks, therefore being able to get or make use of that
Yeah,
tax
look,
credit.
sure, that could be one way, but I should also say that I'm not a planner. So I can tell people what the after-tax result is, but I can't tell people in writing whether or not it's right for them.
Yeah.
That's
That's
financial advice.
planning, and that's not what
Correct.
we do. We're not insured for it and technically unqualified for it.
Yeah.
So we have to be very careful to only issue tax advice, not financial advice.
No, that makes sense. That's very, very clear. We are just accountants, not financial planners, so we need to be careful.
We do.
Jono, look, on the other side of self-managed super funds, there's been a lot happening in the crypto space, and we've had clients ask us about, the tax implications of investing in or getting their self-managed super funds to invest in cryptos. What's your 2 cents on all of that?
Proceed with caution. I've seen it with some clients, and they're typically those clients of the profile that have a really deep understanding of the crypto industry. They have a conviction around certain projects that they want to invest in, and they're taking a long-term view, and that's fine. Who needs to be careful is anyone who may not have done that research and has that deep knowledge around crypto. Some of those clients that have crypto in SMSF have been in the space almost since the start, if not for 5+ years. I've only been interested and involved myself for a bit over, probably 18 months now. And, I can speak personally about the risks with investing via a super fund because recently, as you know, there's been market collapses of FTX, of other exchanges and centralized providers. And there was one small exchange in Australia which went down. I won't name it, but you can find it out there. And I was personally impacted by that. So something that I'm very aware of. I won't tell people to invest in crypto via their super fund. They need to be of the right profile to even consider doing that, because otherwise, and this is where financial advice comes in as well. If it's someone who doesn't have financial skills and deep knowledge about investing themselves, they should probably get some advice from a planner as well as the accountant who can then help them manage the structure going forward. So that's more what I do with some of the SMSFs that I do who are interested in crypto.
Makes sense. Seek help. Okay. Can you touch on a few misconceptions of crypto tax?
So some of the main misconceptions that I come across, number one is I only pay tax on crypto when I transfer it back to fiat, right? Or Aussie dollars or whatever currency you're using. Wrong. You are taxed on crypto because the tax rules that are used with crypto, and this was confirmed recently, the capital gains tax rules apply to all crypto. That means when I exchange Bitcoin for Ethereum for any other altcoin, that is a taxable transaction. When I exchange Aussie dollars for bank shares or for crypto, that's not a capital gains event because I'm using currency. So there was a recent law that was confirmed. It's been around since 2014 in the ATO's, the tax officer's view, is that Bitcoin and crypto is not a foreign currency.
Just to finish off on the crypto space, with everything that's happened recently in 2022, has your opinion changed and outlook changed on cryptos?
I think it's really be careful, do a lot of research, and a trend that I'm seeing is where possible, take custody of your own crypto assets. That's the original draw card of crypto. That's why crypto exists really, is to be able to have ownership of your own assets rather than trusting a third party. So what happened with FTX, other exchanges, was really a result of trusting a party that shouldn't have been trusted because they didn't have typical controls. They weren't regulated.
Yeah. So in summary, it sounds like, your view is it's not going to go away, but you definitely do need to do that research, making sure that you then take custody of what you're investing in terms of the cryptos. But to touch on FTX, you mentioned that quite a bit, and it's made headlines everywhere. Now, some of the things that businesses can actually learn from the FTX failure is having financial control. I think you touched on that as well. A lot of their employees were approving their own, having their expenses approved via Slack through emojis. In our world, we don't really see that. John Ray, I think, is the person who's actually overseeing that right now, and he oversaw Enron, the failure there, and doing a deep dive into what actually went wrong. And the biggest reason why it failed is the lack of record keeping. And that means having that financial control. What does that actually mean? That's having an accounting system in place.
And even things as simple as labeling bank accounts. Going back to FTX, I think they had all these bank accounts and they didn't even have a register of what each bank account was and what it was for. Just simple things like that.
Yep.
To make sure that you've got control of your cash.
That's a good point as well, because once business owners, they see a lot of money coming into their business, right? But they don't have that control, as I said, but also the discipline not to spend that money, knowing that $100,000, a portion of that belongs to GST, to the tax office for GST. A portion of that needs to go to super to pay the superannuation for your employees, but also a portion of that needs to go to income tax, employee tax, all these things. But some clients we see, the money comes in and the money just goes out.
So Phil, would you recommend that clients have separate bank accounts for example, GST and income tax and maybe wages or another category of payment that they need to make? Or would you recommend some other system for tracking where to allocate and how to allocate cash payments?
Yeah, good question, Chris. I would say a rule of thumb for any business owner starting out where they don't have the funds to have an accountant in place or a business advisor is to, put away 35% of what they bring in. That's 10% for GST and 25% for the company tax. That's probably a bit conservative, but as a rule of thumb, that's what they should be doing. For more established businesses, they definitely should be working with their accountant on at least a monthly basis. Reason being is at any point in time, and what I do with my clients is I tell them to look at their balance sheet. The numbers are then finalized. Here are your numbers. This is how much GST you owe at this point in time if the year was to end. This is how much income tax your company has to pay at this point in time if the year was to end. This is how much payroll, super liabilities that you have to pay. So you don't really need, some clients I see will have 3-4 different accounts for those taxes and those liabilities. You don't really need that those 4 accounts. You just need the one. But you need to understand the balance sheet and the liabilities at the end of each month so you can put away. And then that allows you to then go, okay, this is the surplus available for me to either take out as profits or, as a wage, or to reinvest back into business to grow that business. This is all we have time for this episode. Thanks for joining us and tune in for the next episode. If you liked or loved what you heard from us today and want to get in contact with us, please email us at podcast@solveaccounting.com.au or head to our website and fill in the contact form. Thank you and see you next time.